This is Dividend Talk, Episode 1. Hey guys, this is Engineer My Freedom, and today I'm here with European DGI. Welcome to our new weekly podcast where we discuss dividend growth investing and related news from within our community and the stock market. Coming up in this episode, we will look at the news this week. I'm also excited for DGI to share his portfolio allocation strategy. We'll also comment on one of our followers' portfolio, and as always, we will share our favourite stock picks and we look forward to the upcoming week. All that with a European flavour and more on the way. Before we start, we just wanted to say a huge thank you for all the support we received on our very first show. It's always nice to hear positive feedback, and we want this channel to have a community feel to it. So please keep getting involved and leaving us feedback, because we'd love to hear from you. With that said, let's get straight into it. Hey DJI, great to speak with you again. How you doing?
I'm good, thanks.
So I was just wondering, what was your topic of the week about the news?
So maybe it was not exactly from this week, but from the week before. For me, a big historical moment has happened last week, and that was that Unilever decided to list its company in the UK only and create a UK parent company. As some followers of mine know and following my blog, they know that I'm a big fan of Unilever. I've also really been going through the dividend history, and you need to know that I actually had every annual report in my hands from the last 90 years. And it's a really big moment that they stopped this dual listing, because if you think about the Second World War, I went also through those historical reports, and those annual reports, you get really a good feeling of the time, and it has saved the company at the time that they had a dual listing. You can literally read in one of those annual reports that the board of directors from the UK listing are literally mentioning that they haven't been able to be in touch with the Dutch board of directors, so they cannot include their earnings in their annual report. And this happened for 3-4 years in a row until I think 1946 or 1947 again, when the company really stood up from and built it up again after the Second World War. So this is really historical what's happening now. I know there's a lot of sentiment around it, because I think 2 years before they wanted to have the listing in the Netherlands. In the Netherlands, there was a lot of resistance around it because it came with a lot of good packages offered by politicians to effectively make it really attractive for Unilever to stay in the Netherlands. So this is a really big thing, and for me that was really the news for the week. I've got quite a large position in Unilever, and for me it doesn't really matter, because in the end they said that they will stay listed in Amsterdam, where I have my shares. So there's not really such an impact for me. I'm just wondering if we get some more currency impact now going forward with the annual reports. So I am fully with it, with the board of directors' decision to simplify it. It's just one of those things that in historical perspective is really, really a big thing. And EMF, what's your highlight of the week from the news?
So Brexit popped up its head again, which is quite interesting. It went away for a small bit with COVID-19, but I was scanning through the news, I think it was yesterday or the day before, and there's an article starting to pop up about Brexit again, which from an Irish perspective is quite interesting. I have a keen interest in it, mainly because I think it impacts Ireland way more than anywhere else in Europe, because we're quite close neighbours. And I think there was 7 studies done, and 5 of the 7 studies said that it will actually be worse for Irish economy than it will for the UK economy, which is crazy. But when you think about it, we export 16% over to the UK, and they're expecting that to drop by about 10%, which is huge for us. It's a loss of about 2.4 billion, which is quite a lot of money for the size of our economy. A hard Brexit for us It means stricter travel. Even within our geographical area, we have Northern Ireland. So even traveling up to there will be difficult, let alone trying to trade, between, I think, beef. We send a lot of beef. That's our main export up there. So there's quite a few challenges ahead. I suppose we'd like to know, it's the uncertainty behind it all that's kind of
Yeah.
troubling. Nobody kind of knows what's happening until an agreement happens or doesn't happen. We can't really plan for it. And there's a lot of businesses over here, and including my own, are trying to plan around what happens with Brexit. How do we manage that? What's the fallout from that? If we're getting goods in from the UK, can we replace that? Can we get similar goods in from Europe? So there's quite a few challenges ahead. In terms of my investment portfolio, it's not a huge deal to me. I'm not that much exposed to UK markets. I'm as you know, I'm mainly involved in
Yeah.
US equities, and the UK stock exchange, I think it's only about 4% of the world economy. So it's not going to have a massive impact for me personally. If you are from Ireland and you are involved in the UK stock market, my only advice really would be to diversify across asset classes, across geographical regions maybe, and just manage risk. There'll be some risk with currency fluctuations. So nobody knows what will happen to sterling. I would imagine it will weaken, but
Yeah.
it's a coin flip. So that's kind of what popped up for me. There was another interesting thing. I don't know if you read about it. Work Hard. I think they're a German processing company that seemed to be in a lot of trouble.
Yeah, I saw them the other day in a picture passing by on Twitter, where it was the most traded company on the Giro, the stockbroker.
Wow.
So I am hoping that not many of the people that are actually owning it lost a lot of money. I do believe that our followers are probably more interested in dividend growth investing. So I cross my fingers that none of them had them in their portfolio, because it wouldn't have been a good candidate for our portfolios. But yeah, it just shows a little bit the craziness currently of the stock market. The same with this Hertz auto car rental company. I mean, I have a feeling that we're living in 1999. So
Yeah, it's certainly uncertainty ahead, tough times ahead, and it's going to be a tough test to navigate these waters over the next few years. But
yeah,
it certainly has the feel of 1999 to it. I'd agree with you. So let's move on to the main topic of the week, and I'm quite excited about this one. But let's have a look at your portfolio allocation strategy. Just tell me a little bit of how you came up with it and your thoughts, how you actually designed your portfolio.
yeah. Well, actually, this has been a journey. So, as I mentioned in the first episode in the pilot, I'm investing now for 6 years. So, I had to learn a lot. And I think a lot of the learnings are accumulated here. There are a few things that are driving my allocation strategy. And I will post a link also in the comment section or in the description of this video so that people can look at it. But first of all, I don't want my portfolio to organically grow and then later I figure out I've got 100 stocks. Because then in the end I could have bought the whole index of dividend aristocrats or even the S&P 500. So I wanted to limit myself. I thought, like, should I have 10 companies, 20 companies, 30? I ended up with 40 because my existing portfolio, when I really started to design my allocation strategy, had already around 26, and I saw all these companies that I still want to have. So naturally it ended up in 40. But at the same time, I also wanted to discriminate between the stocks, because not every stock uh, is so good as the others. So what I effectively did are two things. I thought about how much allocation I want to have per sector, and I wanted to have a certain tier. So tier 1, tier 2, tier 3, tier 4. So the first 10, I want to have around, I think it's 4% of my portfolio per position. So the top 10 for me will be around 40% of my portfolio. And that's really what I call the cornerstone or the foundation really of my portfolio. Then the tier 2 is for me kind of the challengers. They might become foundational stocks in the future. What if one of the tier 1 cuts the dividend and I will decide to remove? So the tier 2 are really the challenges of the tier 1. And those are 3% per position. And then tier 3, tier 4, those are more the ones where you will also see that their business models are a little bit different. For instance, they are industrials, which have different behavior in depending on the market cycle that we are in. And also some companies that I just like to have, but I might not really want to see them as the foundation of my portfolio. So that's how I designed it with that in mind. And also I wanted to have the sectors in my portfolio that I really believe in the next 20, 30 years. So, and also quite a defensive component in it. So you see that the consumer staples 20%, healthcare 20%. I know that healthcare is probably the best performing sector over the last 50, 60 years with, I think, an annual growth rate of 11%. So I found it really important to have the core of my portfolio really well designed around those two sectors, and then information technology, because I believe really in IT, but in some of those companies, not in all of them. So that's really the foundation, the thinking behind my allocation strategy. At the same time, I wanted to keep it really simple. So now what it really allows me to do, I've got a list of around 35 to 40 companies. It's on a watch list. And you know what's the nice thing? There's always one or two companies that are in a value zone to buy. So I've got my pre-selected list. I decided to every half a year an evaluation of it. So I did a spring cleaning in May. I wrote a post about it, what I'm aiming to do. I cleaned some up. There happened some things due to COVID-19. We saw some people that got naked, let's say, that were swimming naked. Also, like, for instance, a company like Shell. So every half year I do a review. So it doesn't mean that this portfolio will look exactly the same in 10 years from now. I think, although it's my intention to buy only companies that I know will do well the next 10, 20 years, I also believe that there is always a black swan event, even for a certain company, that can change. So I do keep an eye, and every half year I want to see, is my thesis about the company still the same or not? As an example, Pepsi is a foundation stock for me. But the more and the more I'm looking at it, I'm becoming a little bit concerned about the sustainability of their dividend. And I have a feeling that quite some financial engineering is going on there. I love the company, but I start more and more doubting about their balance sheet, as an example. So maybe if this feeling starts growing in myself, I might in a half a year from now just drop it from tier 1 and exchange it with another one and put the level down. So at the same time, I get a lot of questions around this and about my allocation strategy versus my actual portfolio now. And what I would like to say is that now I have a lot of energy in my portfolio, but I'm still in the accumulation phase. So back in 2016, when the first oil crisis was there, I bought quite some oil. And I used the downturns to effectively load up the truck, you could almost say. And this done me actually quite well. So when people look at my current portfolio, my actual portfolio might not look the same as my allocation strategy at the moment, because I'm in the accumulation phase. So usually, like Upfi, I bought it almost my whole position in 2-3 months because it was just too cheap to ignore. And that's how I usually go a little bit from stock to stock. And if Microsoft doesn't come down anymore, I might not touch it for the next 2 years, but maybe in the third year, it might be a value play for me. So that's also how I look at it. This is for me for the next 10 years. I can just put my money in those companies that show up then on the radar as a value play.
It's good. It's good to hear your thought process on how you actually come up with your strategy and where your portfolio is at. But in terms of EU stocks and US stocks, what percentage of both have you got? And do they fit into your tiers? Do you have separate tiers, or does it fit into your overarching strategy, so to speak?
So let's say like that. Because I'm a dividend growth investor, the tradition is just the best in the US when it comes to dividend growing companies. That's why you see that the majority of my portfolio and also of my allocation strategy is still US. I've got kind of a minimum requirement that I want to have 30% in European stocks. It's a bit arbitrary. I mean, why not 40? Why not 20? For me, 30 was a nice number. But after my spring cleaning, I can say that's now almost 45% of my allocation strategy, simply because I found quite some good stocks that I would like to have in my portfolio. But the majority will still be US, and probably for a long time, but without studying more European companies, I would have been probably almost only in the US, and that creates then this currency risk that we also spoke the other time about in the first episode. So I'm just glad that I get now a substantial amount of dividends in euros. The only thing is, what I would love to see more is that European companies start to pay quarterly. Most of them, they pay on a yearly basis, so you get a big sum of money, let's say in May, and then you would need to spread it out. Now, the good thing is I've got good financial discipline and control. So if I would know that I would need to live 12 months on those dividend payments, I will manage. It's just nicer, I think, to get a monthly income. And I have a post about that as well, how you can design a portfolio where you get 1,000 euros a month based on purely European dividend stocks. And that was for me also really a thought exercise. Can I actually do this purely based on European stocks? So the good thing is it is possible. It is possible. So
it's great to hear that it is possible, because like you, I started, or like many European investors, I've started mainly in the US, because that's where all the books are from, that's where all the podcasts are from, and US companies do prefer to pay dividends. So it's actually great to hear that you can design a monthly paying portfolio in Europe. So it's something I'm working towards myself, and hopefully I will start adding gradually. I don't have a specific number like 30 or 40%, but I do want to get a little bit more exposure to it. But have you looked at the returns of your EU stocks compared to your US stocks in terms of dividend or dividend growth, or how do they compare against each other?
Actually not, because it's not so really relevant for me how the stocks perform, because I look at purely at dividend growth over time, and I'm still in the accumulation phase. I can tell you that all my stocks are generally growing in dividend. The main one that was not growing for a while was Shell, but they paid me like 7-8%, and then just pushing the drip button made me really grow my dividend income over the last few years. And I think people often forget that, and that's why I'm totally fine with having stocks in my portfolio that don't grow a dividend for a year, because if you turn the reinvestment in and you have a high yield at that time, because usually those stocks are under stress, you still grow the dividend because of the snowball and the compounding effect. So no, I've not been measuring individual, but if you just look at the stocks in the portfolio, most of them average around 6 to 7% in growth per year, and that's what I'm looking for. So it's already actually part of my selection criteria. I prefer around 3% yield under these circumstances where we live in a zero interest environment, plus around 6 to 7% growth on average. And my portfolio does pretty well on that. I don't look at stock prices. It's not really relevant. The only thing what I measure is how much money have I contributed over time and what's the value of my portfolio now. And then I know that I'm 50 to 60% up, and you shouldn't think about it from over a 6-year period, because probably the most money I would have spent or invested the last 2 years. So I think that's a pretty good return and much better than my savings account.
Indeed, I'd imagine it's way surpasses your savings account. So just aside from dividend growth or dividend stocks, have you got any speculation plays or anything that you just put in there as speculation?
Speculation is maybe too big of a word, but I have 10% in my mind of my portfolio, which is a bit outside of the allocation strategy, which I consider a little bit like mad money. So I think most of the followers or listeners to this, they wouldn't call Facebook mad money, but in my conservative approach, buying Facebook, buying Google, non-dividend paying stocks were for me more growth stocks. I actually would like to, for instance, find the next workday as an example. And I have in my mind 10% of my portfolio I would like to invest in such stocks, but that's more for the fun fact and to learn how to invest in growth stocks better. So I don't have a Tesla and such, but I've been looking into those companies and just never pulled the trigger. But yeah, so 10% of my money I'm willing to spend on growth stocks.
Very good. We'd all love to find a Tesla or an Amazon or something that just blows up.
I guess I guess what the main thing is, I'm so focused on dividend growth stocks that I hardly have the time to look into growth stocks. So although I have it in my mind, and you see 2 or 3 of such stocks in my actual portfolio, I just really don't have the time to study those, and I'm not good at evaluating growth stocks. So hence why I might have it in mind. I'm just not actually walking the talk here for that reason. It's just a matter of time.
Stick to what you're good at, and you can always work on growth stocks in the future. But
yeah, thanks. Hey, but EMF, now that you know a little bit my allocation strategy, I would also like to discuss a follower request that we got. So one of our followers, his name is, and I hope I pronounce it well, Tsalin Churariu, shared his portfolio with us, and he's really looking for some feedback from us. So I shared this portfolio with you, and I will actually put it on screen now. Shall we give him some feedback and our thoughts on what we have seen?
Of course, I would love to. So you said that to me earlier on. I had a quick look at it, and the first thing that struck me was there were some very strong companies on there, well-known companies. You've got companies like Danone, Nestle, Unilever, Sanofi, Siemens, and a lot of these companies actually are based in Ireland as well, which stands out to me. Like JSK and Sanofi are within walking distance of where I live and stuff. So quite strong brands, which was the first thing that popped out of me. I did some work and put him into their sectors and just to see what his allocation was, and it's well diversified, which is good. I think it's quite defensive. He's got a lot of healthcare, a lot of consumer defensive and energy stocks, and it makes up the bulk of his portfolio. What did you think of his allocation? And
so, like you mentioned, I think his sector diversification is quite well thought through. I also really like some of the stock picks, like you said, Novo Nordisk, Danone, Unilever. I think those are really some good picks. And if his goal is really to build a long-lasting portfolio, then I think he will do pretty well with those. I did write quite a critical article criticizing Nestle based on that they are effectively fueling their growth with loading up lots of debt. And I also gave a sell recommendation there. So in my opinion, I would say, like, have a look at that article, Tsalin. Look at the data that I'm presenting. I honestly feel that Nestle will not be your growth company or a good dividend growth company into the future. I think in this case I would just drop it and stick to Danone and Nestle, and that gives you already enough diversification by those two companies. Another invitation to consider is that I saw Euro Commercial Properties in there. It's a real estate play. I'm a bit concerned about that company. There's a lot going on there. I know that they were also building some shopping malls in Italy, in France. And if you now look at consumer behavior, and if I look at myself, I start to buy much more online. Also, when it comes to shopping, I don't see a reason why I will go back to the old behavior. It has really done me well. So I'm afraid that this company, as a real estate, that their dividend might not be sustainable. They also wanted to pay 2 times the dividend a year, if I remember correctly, and they withdrawn that. They will revisit that later again. Usually these are these subtle signals that there is something going on, which means that the company is currently already under stress, but I know they have a really, really juicy yield. And that's probably what's attractive to selling. But in this case, I would probably go just for realty income in the US, which I find a much better quality portfolio of real estate than what Euro Commercial Properties is offering. So, but I think overall pretty good portfolio.
It's good. It's good you mentioned realty income because they're a US based stock. And one thing I've noticed here is that there's no US stocks. It's purely a European based portfolio. Maybe I'd love to hear your thoughts, but maybe he should look at introducing a few more US stocks into his portfolio.
Yeah, I would say so. And for instance, one of the sectors I think that was missing was the IT sector. And if you look at that, I think diversifying a little bit into information technology, give that a little bit more presence. I know there are not too many companies in Europe. I think SAP is a company here that you might consider.
He has SAP
Yeah,
in
yeah,
the
exactly.
portfolio. Yeah.
But why not also some more Apple? Just I know it's a bit hot at the moment, but maybe a year from now they usually go in this 2-year cycle that suddenly everyone says that the iPhone is dead, and that's usually the right time to pick up Apple. I've done it twice so far, and it's doubled my money and still growing dividends. So yeah, I would definitely recommend some more US exposure here just for the geographical diversification.
Maybe even an ETF. Maybe there's a
Yeah,
European ETF for technology. I think it's the iShare Stocks Europe 600 from the top of my head. You get a lot more exposure to technology
yeah,
stocks. I'm sure there's an equivalent for the US as well if you're not comfortable in picking individual technology stocks.
yeah, definitely.
But overall, it's quite a good portfolio. I think you can see there's strong foundations there, and if he keeps building in the way he's going, I think he's in to see some solid growth in the future.
Yeah, super. So thanks, Salim, for sharing. I hope this feedback helps you in your journey. Let us know via the comment section or just drop me a DM, and I'm looking forward for your response. Okay, so I think now we come to the section of which I always really also enjoy is the stock picks, because I'm really interested in what company you will put in the spotlight for the upcoming week, EMF.
Of course. So the company I chose this week was ADP, so Automatic Data Processing in the US. So for those that don't know, automatic data processing, they engage in payroll and HR and HCM solutions for large, medium, and small businesses. So when I was looking at them, I was looking at the revenue over the last 10 years and their earnings, and they've seen some solid growth. So I think it was average about 6-7% per year. They had a slight dip in 2012 in their earnings, or in the revenue, sorry. But overall, you've seen a 7% growth over the last 10 years, which is quite strong. They were forecasting another 7-8% growth this year. Before COVID, I think that's been reduced now down to 3 or 4%, which, given the current situation, is still quite strong. Um, they've got a dividend growth of, I think the last dividend increase was 13.39%. Their average is about 15% over the last 10 years, which is quite a strong dividend growth. And I also look at, as you know, the free cash flow payout. So I think that's 60% at the minute. So they've got plenty of room to grow. Their earnings seem to be, earnings per share is growing, their revenue is growing. They're moving into the cloud. They look quite strong. For me, they have a strong balance sheet. They have huge potential for dividend growth. And I just don't see them slowing down anytime soon. So that's who I'm considering this week.
Cool.
So what about you? Who are you going to pick this week?
So I'm going to pick Chubb. I bought Chubb not long ago. So the insurance company, currently based in Switzerland, but a US originating company. I bought it at $100 when it dropped after COVID-19, even not straight away in March, I think back in April. And for me, this is just, again, a great company. They've been growing the dividend since 1994, so for 27 years already. In the last 10 years, their growth rate in dividend was 8.6%. Their payout ratio currently stands around 35%. And it spots currently a yield of 2.45%, mainly because their dividend payout is 78 cents per quarter or something like that. Why this company? I think it has a really good value. I think it spots a PE of 16 now. I know that PE is not the only measure we look at, but just to keep it simple for this stock pick discussion now. But for instance, I love it as an insurance company. We can count on it. It's a good, just chugging along every year. And the price went quite down because a lot of events got cancelled, and it has some exposure in it in the portfolio. When I saw the initial results coming in, that took all my worries away around Chubb. I know this will still exist in 20 years, this company, and it will be still growing dividends. And I find it at a price of 128 euros. I still find it a good price to consider. It shouldn't go too much higher anymore, then I will pass on it. But let's say between 100 and 130, it's something that I really consider. There's just dollar cost averaging in on. So that's my stock pick of the week. And I'm going to put the purchase order out again for the upcoming week.
Yeah, interesting.
So this was my dividend stock pick from the week. We heard yours, ADP, Chubb. I'm actually really interested to learn also from our followers and our listeners what their favorite stock pick for the week would be. So if you have one, please drop us a note on Twitter, tag us, and I would really love to hear it. And maybe it's something that inspires us as well. But actually, having said that, we came already to the end of this show, EMF, and I really hope that everyone that was listening today enjoyed our show. If you did please leave us a comment and show us and tell us whether it's worth pursuing going on like this. We would also love to hear from you if there's anything that you would like us to discuss in upcoming shows, but also if you have some requests like the one that Saline had to us, we will be more than happy to have a look at it and see if we can discuss it in one of the upcoming shows. You can find us both on Twitter. We'll put the links in the comment section in the description, and you can also email us at dividendtalk@gmail.com. So EMF, this is the end of the show. Any last words of wisdom from your side?
Yeah, thanks very much, European DJI. It's been a great chat. As always, like you said, I could probably sit here for another couple of hours. Thanks to all our listeners again for the first episode. And if you listened this far in this episode, we do really appreciate it. If you would like to hear more from us, please hit the like button and the subscribe button and turn on that bell so you'll get notifications of any upcoming podcasts. But we do really appreciate your support, and we look forward to seeing you again. Thanks a million. See you soon.